Hi, I'm Ben Gurwitz, a certified financial planner and CEO of Financial Life Advisors. We're a firm that helps families navigate investments, tax, insurance, and their estates to help them achieve their life goals. Specifically today, I wanted to put together a little video to cover the One Big Beautiful Bill Act, specifically what those changes in that bill mean and how someone may benefit from them, not just today, but when keeping a long-term view. Of course, I always need to put in our disclosures. We are not CPAs. We are not attorneys. We don't give legal and tax advice, but we will cover some of these topics, and I encourage you to work with your attorney, CPA, or qualified professional before implementing anything you hear about today. In the OBBBA, there are several things that we want to cover today. Some of the changes. We're going to talk about what the change is, who is impacted by that change, and how you might benefit from those changes. In addition to the tax rates that were passed in 2018 becoming permanent, the new lower rates are now permanent rates, there were significant changes to itemized deductions. One of the controversial things that happened before when the standard deduction was increased was a limitation was put on state and local taxes, otherwise known as SALT, or referred to as the SALT cap. It was only $10,000. So if your state income tax or property tax or sales tax combined exceeded $10,000, you were only able to count $10,000 towards that. That has been raised to $40,000 effective in 2025 and is set to continue until 2030. So that means a lot more taxes that are paid are potentially deductible as itemized deductions. So oftentimes, under the rules with the higher standard deduction, people could not itemize because they didn't have enough to pay versus the much higher standard deduction. Now, there's a potential to have a lot more tax included. In addition, mortgage insurance premiums have been added back in as an itemized deduction. And for the first time ever, a phase out of charitable contributions has been added to itemized deductions. The first 0.5% of adjusted gross income is excluded from itemized deductions on charitable contributions. This is brand new and makes it a little bit more challenging, but is a relatively small change. Additionally, there were some limits on wagering losses. You used to be able to write off all of your losses against your gains. Now you can only write off 90% of your losses. And then educator expenses, a special item. Educators have had a deduction, a credit available to them for out-of-pocket expenses. Now, if they have additional expenses, those can be added as an itemized deduction if they itemize. So who does this affect? Families paying high state or property taxes. In Texas, we pay a lot of property tax. In other states that have high income tax, people are paying a lot of money to the state governments, local governments. Being able to deduct those against federal income as an itemized deduction will be very beneficial for those. Anyone who has a large mortgage, pays a lot of mortgage interest, has to have mortgage insurance will benefit. And those with charitable intent need to pay attention to this. And the rules around charitable giving. With this new limitation, it shouldn't have a huge effect, but there are some extra considerations around it. And then anybody who has out-of-pocket expenses as an educator, if they're itemizing, they get an additional benefit. So one of the most important things to remember when thinking about itemized changes is the standard deduction versus itemized. And in Texas in particular, we can choose when to pay our property tax if we're a homeowner. And we can double up our property tax by paying it in January and December and flip-flop between the standard deduction and the itemized deduction if it makes sense. So really think about when you pay your property tax and when you make your charitable contributions. You can use strategies to bunch your property tax and bunch your contributions to charity, where one year you take a really large itemized deduction and the next year you fall back to the large standard deduction. This is something that was very common prior to TCJA, but now is potentially available again. You should also consider coordinating donations with higher income years. That goes back to that bunching. And in years where you make more money, the value of those charitable deductions is going to be higher. So think about that. This gives us some more planning opportunity around itemized deductions. Oops. New this year and for the next few years, there is an extra senior standard deduction. That extra senior standard deduction is, in addition to the standard deduction of $31,500 for married couples and the over 65, which is an additional $1,600, there will now be an extra $6,000 added onto that. So a married filing jointly couple could have a total standard deduction of $46,700. A single person who's over 65 could have a standard deduction of $23,350. That's huge numbers compared to what we've had. But higher income retirees need to be careful because this $6,000 is not for you. For singles, there's a phase-out range where you lose this extra deduction from $75,000 to $175,000. And if you're married, from $150,000 to $250,000 in income. So you can actually see if you're over 65 and have a big income year, if you were to receive a significant amount of income from, say, a capital gain or a retirement plan distribution, it could actually lower your standard deduction that you would get. So be careful of those limits when thinking about income. We like to call this a tax torpedo, something that's below the surface that we don't necessarily think about, but when we have income, it can affect us in strange ways. Losing this extra $6,000 deduction based on income is one of those. So try to keep under those limits if you can. For those that get to take advantage of this extra $6,000 in deductions, it potentially has an opportunity to increase income and be able to offset it with the deduction. So there could be additional income that you could accelerate from IRA distributions or Roth conversions that would potentially be an advantageous time to do that. This is not a permanent $6,000. This will phase out at the end of 2030, I believe. Additionally, there are new Trump accounts, as if the alphabet soup of 401ks, 403bs, 457s, IRAs, Roths, 529s, all of those weren't enough. Now we have the Trump account. And the essential reason why this was set up is the ability for money to be put for children or grandchildren. They don't need an income. It kind of looks like an IRA, but doesn't require someone to work to be able to contribute to it. Essentially, children starting in July of 2026 will be able to receive up to $5,000 a year per person into a Trump account. It'll get tax favored status and will have to be invested in index investments. Once the child's 18, the details on what happens are somewhat murky. They haven't worked out all the rules on this. And to help get the program started, if you have a baby in 2025, 2026, or 2027, the government will give you an extra $1,000 to start your Trump account. Again, how that will work exactly is not 100% clear. Who does this affect? Well, grandparents or parents wanting to fund generational wealth. If you want to move money to the next generation, this is another way to do it. It doesn't impact other contribution limits. Employers, interestingly enough, are also allowed to make contributions, and this could be used as an employee benefit. But you want to be careful to compare the Trump account versus college savings accounts like the 529 and trusts. The protections found in those, the tax advantages of those, the reasons for those could compete with what you would do in a Trump account. So make sure to explore those before you do anything. But it does give you the ability to transfer wealth to the next generation in a tax advantage manner. It can be used for education, a first home, or even retirement. So it's a little bit more flexible than a college savings account and what it can be used for. Another big change is the increase in the estate tax that happened when it doubled has been made permanent. So it's about $15 million a person now. So if you pass away and your estate is $15 million or less, there is no tax to pass that on. If it's above $15 million, you need to have a conversation with an attorney in advance. And if you're a married couple, some basic planning can extend that to $30 million. So if you had an estate that was between 7 and 15, you had some tough decisions to make going into 2026. Some of that has now changed. So people who have significant wealth, this is a big benefit to their estates. How does this affect you? Well, a little bit less urgency to gift aggressively before 2026 if you do have a large estate, and give some more flexibility for that estate planning that you want to do. With this, you can still use family limited partnerships, gifting trusts, grantor retained annuity trusts, and shift growth outside of your estate, but it won't be as necessary with a higher estate tax limit. Another thing that got extended or maintained is the alternative minimum tax exemption amounts, the phase outs. A lot of people were being ensnared in alternative minimum tax, which is a side-by-side tax system from income tax, and we haven't had to deal with it very much since. Specifically, this extension keeps that from being a problem for a lot of people. But people who are very high earners with really large deductions and business owners with incentive stock options are also people that typically get ensnared by the alternative minimum tax. So this won't be as much of a problem if it had expired, but if you have really high itemized deductions, you could still be ensnared in the AMT. You want to take a look at how the tax situation and if AMT affects you, because if you are subjected to AMT, you may want to consider some other strategies to accelerate income, ordinary income specifically, to get out of the AMT and take advantage of that rate. Another change, the child tax credit. It's been expanded. It was going to expire. It has been expanded to $2,200 per child, with most of it being refundable, meaning if you don't pay the tax, any tax to the federal government, you can still get a refund, but not for the full $2,200, only $1,700. It is permanent and adjusted to inflation going forward. So if you are a parent with children that are 17 or under, you get this tax credit per child, but the phase out remains. So if you're single and you have an income of $200,000 or more, or $400,000 married filing jointly, you ultimately can lose that phase out and not get the child tax credits. Obviously, for people who are under those income limits and have children, the tax credit is very valuable. But you want to make sure if you're near those phase out limits, again, income management and keeping your taxable income could have some additional benefits and avoid some of those tax torpedoes. Also in the OBBBA are education scholarship credits. These don't take effect right away, but they're a very peculiar thing that was added into the bill. Essentially, it's a dollar for dollar $1,700 tax credit, where if you gift $1,700 to a scholarship granting organization, you can get $1,700 credit on your tax return. Essentially, you can give $1,700 for free to a scholarship granting organization. What is a scholarship granting organization? Well, the rules around that are not 100% clear, and the states will be deciding a lot of those rules. So stay tuned for how this is going to play out. Essentially, this is to help public and mostly private schools provide scholarships to middle income and lower income people using federal money and this tax credit. So expect to be hit up for this credit from scholarship granting organizations. And for $1,700, you can give that money to fund scholarships without it really costing you anything. So stay tuned for more on that. Green energy credits. These were one of the casualties of OBBBA. If you didn't buy a car by September 30th, if you don't get all of your green energy installed by the end of the year, then you don't get those very lucrative tax credits anymore. $7,500 for new electric cars, $4,000 for used electric cars. Energy home improvements, the 30% residential clean energy credit, they're all going away. If you haven't already gotten these purchased or in process, unfortunately, they're essentially gone now. And if you have a project that's ongoing for the residential clean energy credit or home improvements, make sure it's done and in service by the end of the year. Some other unique and new things are new pay rules on overtime and tips. So a new tax credit is available to offset taxable income on up to $25,000 of tips, and depending if you're single or married filing jointly, $12,500, $25,000 on overtime pay. But these also phase out at the $100,000 and $200,000 limit. Now, enterprising individuals may think, oh, we can restructure compensation at our business to help people exclude some of this income. There were some rules put in place for payroll structuring, but it must be a typical tip-paying industry and not a specified service, trade, or business. So you want to make sure to check with a payroll provider or your CPA before trying to change how you compensate employees to take advantage of these tax rules. And they are not permanent, so you would be making changes for just a handful of years. Like homeowners insurance and the itemized deductions, you now have the ability to deduct certain vehicle loans used for personal use. If you purchase a new car in 2025 or later, you can deduct up to $10,000 a year of interest. There is a phase out for this too. Like most of these bills, most of these provisions, they have their own unique phase outs and they're not all the same. But it does effectively lower the interest rate that you'll pay on a new car loan. So with higher interest rates now, there's a little bit of relief on your tax return. But the car must be assembled in the US and weigh less than 14,000 pounds. So it won't work for everything, but is another sweetener if you're looking at getting a new car. So with OBBBA, simulation is key. There are so many moving pieces with phase outs and this year and next year that advanced software really makes this much easier to run various scenarios and see what's going inside of a tax return. Anyone who's filing their tax return and has ability to adjust any of their items, compensation, charitable giving, retirement accounts, should be looking and thinking about how these rules affect them. You can use simulations to guide Roth conversions, gifting strategies, drawdown scenarios for retirement, and you can compare what happens if the tax law were to sunset or go back to the old rules or change in the future. By knowing what the future looks like, it really helps us make decisions today and act with clarity. So some of the resources used to help prepare this presentation are listed here. Feel free to use those if you would like, get more information. Some frequently asked questions and next steps. You can always schedule a complimentary consultation with financial life advisors or contact your CPA to ask about how these tax laws may affect you. You should review your estate and gifting plans. You should look at Roth conversions and traditional drawdowns of retirement accounts in retirement. You want to stay ahead of these permanent changes so that you understand how they may affect you. And if you would like our help, we can build a custom action plan for you for the next 5+ years to make sure that you understand what you should be doing and why going forward. If you'd like to schedule that consultation, you can email us, call us, go to our website, or follow this QR code to meet with us to find out more about your financial journey and see if we can be of assistance to you. Thanks.